Hey everyone, welcome to the KE Report and a daily editorial on Wednesday, June 18th, chatting with Mike Larson, editor-in-chief at MoneyShow. Mike, as we always do, we'll go around the horn talking about a number of different markets, what's driving the markets. And I feel like we need to start off with geopolitics, unfortunately. The whole Israel-Iran conflict that is continuing to escalate or really started to escalate earlier this week and last week. We're seeing oil really impacted by that. Not a whole lot else on, let's say, the gold front or the broad averages front, but we can get into why that might be. But first and foremost, this conflict, man, it's completely changed the picture for oil. Oil was trading outside of its multi-year range, below about that $65 a level, but has very, very quickly rebounded as we're chatting. It's $75 a barrel, right back into the middle of that range. But again, so much of that does seem to be driven by this geopolitics. So, Mike, what do you take away from what's going on? Not so much in Israel and Iran, but what's going on in the market reaction sense with oil?
Yeah, I appreciate you having me on. It's kind of funny. We just reversed the digits for crude oil. We were at 57 bucks at the low back in May. Here we are at 75 bucks as we're speaking in mid June. Geopolitics, the tensions, fears of the Strait of Hormuz getting, partially blockaded, attacked, and, attacks on energy facilities in the area, worries about, if Iran decides to attack US bases. I mean, there's a lot of just there are people that are a lot smarter than me that know a lot of the ins and outs of this space better than I do. But from a big picture market standpoint, clearly, markets are on pins and needles, watching what's happening, wondering how it's going to sort out, and wondering what to do. I mean, what's the upside in oil, gas, diesel, in those markets, depending on what happens? What's the downside if the political tensions settle down? I can add, I've had a couple of interviews with a couple of our best energy experts, and I think one thing they do tend to agree on is that because of the US dominance in the energy industry in terms of producing energy now versus obviously the 1970s, plus the fact that a lot of Iranian exports aren't going to the US at all, they're going to China and other places that are willing to take Iranian oil at a discount, sort of in the shadow market despite sanctions. I think, there tends to be, unless it's an absolute doomsday scenario, there tends to be less concern about a sort of a super spike in oil prices in this current conflict than maybe there has been in the past, and certainly in the 1970s when the whole Arab world sort of united in an oil embargo to push back at the West. With that said, I think what's interesting from a market standpoint is we had the big, whoosh lower on Trump trade and tariff fears. We had the big rebound on sort of that taco trade that everybody's talked about. It's sort of the new acronym on Wall Street that basically it means the same thing as buy the dip, as we've talked about. So the market's round tripped quite a bit, and it's hard to make progress here in the bigger picture with, in the short term, a geopolitical threat. And in the longer term, questions about the economy. I mean, the Fed's not going to, isn't cutting rates here, but they probably will a couple times later in the year. And why are they going to do that? Because at the margins, the labor market's weakening a little bit. Inflation's come down. So far it's sort of that quasi soft landing story, but Wall Street will be kind of nervous. Does that continue to be the case, or is the tariff uncertainty and stuff and things tied to it, plus the weakening labor market, mean that it's going to go from being a soft landing to something worse? At the same time, all the sort of hoped for tax stimulus, big spending reforms and tax cuts and things like that out of Washington, that's been sort of caught in the quagmire of Washington politics versus being rammed through given the political environment. So, you don't have that big sort of push behind the markets. And then there's the question of deregulation. You are seeing progress kind of on that front in a Trump and Republican-led Congress and administration, but that helps around the margins, but it's not sort of something that's going to unleash a huge new profit wave. Broadly speaking, for the S&P, it's going to be more sort of a sector type thing. You'll see it in energy, you'll see it in financials, and so on. So long story short, again, we've retraced the big sell-off, but to really make progress from here, we're going to need answers to questions on economic strength. We're going to need some progress in DC in terms of legislation on tax reform, tax cuts, deregulation, and so on. And we're going to need to see, confirmation that the Fed's going to be cutting, but not cutting because things are falling off a cliff, but because, there's just a little more slack in the economy. So we're in this sort of wishy-washy, no big trend environment while a lot of these issues and questions are sorted out and answered.
Mike, how do you view that oil market right now? Is it balanced, as you said, the U.S. dominance, or at least the U.S. role in the oil market when it comes to production has been strong. There's less rigs turning in the U.S., and we have seen oil production decrease slightly this year and even over last year, but still, we're talking 10, maybe 15% less oil production when you consider the high levels that US is producing oil at. But then you look on the flip side, and OPEC Plus, they've actually been quite vocal saying they want to take back some market share from the US, and they are okay. They think the way to do that is by pushing prices lower. So again, that whole supply demand aspect, is the market balanced, and should the, I guess, oil bulls be worried about OPEC Plus trying to take back market share by lowering the price?
Yeah, I mean, let's face it. Again, this is not a extremely tight market. Even if this conflict hadn't happened, this newest, turmoil between Israel and Iran hadn't happened, you did have a market that, had demand that wasn't fantastic and supply and excess supply that had been voluntarily shut off, or in the case of the U.S., was starting to decline due to decisions that producers are making. But you had that OPEC plus sort of ability to spare capacity, what have you, that they're voluntarily reducing, but could be taking back share. So you don't have a wildly bullish environment outside of some of the geopolitical stuff going on. I also don't think you have a wildly bearish environment. Again, it's not something like in COVID where demand was collapsing, or it's not something like in the past when there wasn't this big US production boom, there wasn't a lot of OPEC plus spare capacity, and therefore you had an extremely tight market. It is more balanced. I think that's a good word for it. Obviously, until the geopolitical situation is sorted out, you're going to have an upward bias. But I certainly, again, some of the smartest people I listen to, hopefully this doesn't come back to bite me, but they're not saying, oh, this is going to be the kind of thing that's going to drive oil to 120, $150 a barrel unless things get wildly out of hand, just because, again, the underlying energy market dynamics are different now than they certainly were in the 70s, and different even than they were sort of in the 90s and 2000s, early 2000s, before US production really started taking off. So yeah, I think it's a market that's probably balanced. I think there's still some opportunities in the yield type plays in that market, because I don't think prices are going to completely fall apart, and therefore volumes are going to completely collapse in terms of getting oil and products and nat gas and LNG and so on from point A to point B. But I don't think this is a kind of environment where producers, explorers, you're going to target them and they're going to make an absolute killing because prices are going to surge.
Yeah, it's funny that you say even the guys you're listening to aren't calling for the 100 plus the triple digit oil prices, because I'm hearing the same thing, which, hey, maybe means that everyone's discounting it too much that it'll happen, but it does seem like a balanced market, and everyone's waiting for where that next major driver is. And unfortunately, right now, it just seems to be this Israel-Iran conflict. But again, oil's just right back into the middle of a range that it's been in. What else on the back of this conflict have you noted, market-wise, metal-wise, in terms of either price movements or lack of movements?
Well, sure. I mean, obviously gold's been on a tear for a long, long time, even before the conflict kind of gave it a little extra juice. We hit what, 34.50, I think, in US futures the other day, which was essentially a modest new record. We've pulled back a little bit from there. So you've got, some safe haven buying in gold, concerns about geopolitics, money coming into that sector for sort of the insurance that gold provides. But what I think is most noteworthy to me is that, in the last few months, really, you've seen a lot of the other metals join in the fun, the bull market. I mean, you've seen platinum, you've seen palladium, you've seen silver, certainly, and to some degree, copper rebound from its lows, that, the sell-off driven by the tariff stuff. That's what you really want to see if you're a metals bull, because it speaks to the potential duration and magnitude of the move here. When you just had gold that was predominantly rising on kind of, countries looking to get out from under the dollar-driven system when it comes to trade and reserves and so on, and central banks trying to diversify into gold and out of, paper assets and when the dollar sells off, trying to get into counter dollar plays, all that stuff is great. But when you see other metals moving, the mining stocks moving, it confirms that advance. It shows that big money is really getting involved and it's broadening out. I mean, I think if there was an Achilles heel to the bull market story for metals, it was that previously miners weren't participating. And previously, silver and platinum and palladium and some of these other metals that are in the precious and industrial space weren't moving. But that's all changing, right? So as a bull, I find it very encouraging because I think it validates and confirms that story. So that part of the market still remains very interesting to me. And I think that, the demand dynamics are better than energy. The sort of big picture fundamental forces are better than what you might see in energy. So that's kind of the part of the commodity space I think it makes sense to play in now and probably for a good time to come.
So on this rotation theme within the metals, you're right. We've seen other precious metals pick up the slack as gold is mostly trended sideways now for a couple months. To keep this overly bullish narrative, though, do you think we need gold to make another leg higher, at least in a few months, just to keep showing that big money is coming into what it usually does, gold first and then trickle through to the rest of the other precious metals?
Oh yeah, no, I definitely think it would be nice to see that kind of that March, that break above this sort of 3,500 nice round number level pretty definitively and with some volume and so on. And from a technical standpoint, you'd love to see it, and I think that would certainly help further validate and further encourage investment in the space. And I think it's going to happen. I still that one day where I want to say futures, I think, blew out up 100 and then reversed and we're down like 100 in one day. I mean, you had kind of that like a shooting star, whatever sort of technical pattern you want to talk about in the futures market. That I think, is a reason that was at the tail end. It was, kind of euphoric, or it came after a very strong move for many weeks. And that was, to me, sort of a short-term technical signal that things were a little exhausted and you're going to see some consolidation. And sure enough, that's what we've seen. But, that's more sort of from the shorter to modestly intermediate term time frame. I don't think it says anything about the full sort of long-term bull market. And so I'm not worried about that. I do think we are going to push, and I do think we are going to see that, a move past those levels and, probably sooner rather than later.
Now, one thing I want to get your insights on is because you watch so many different markets, but still focusing on the metals, especially precious metals, is that precious metals, resources broadly, are just so underrepresented in the indices, in the broad averages, which is why they don't get, I think, the same media coverage. It's also the problem with broadly these markets are, in a way, kind of small compared to what the tech market has turned into, compared to all kinds of other markets within those indices. But one thing I've noticed recently is on, let's say, the chart of GLD, we've seen some higher volume come in. We've also seen some higher volume on SLV, the silver ETF. What's your thought on, again, the interest that could come into the sector, but it's just so underrepresented? One mining company is in the S&P 500. People don't really seem to care that much because it seems almost too small for some investors, but it has the momentum now. So how do you balance these two factors, the underrepresented nature, but the momentum that it has?
Yeah, I mean, look, at some point you've seen, for example, in some of the platinum ETFs that, are a little less, they're a little more nichey than gold, than GLD. You've seen some big moves in a short period of time, some big flows relative to what's normal. So yeah, you always do have to kind of eyeball how much mainstream or hot money, sort of with quotation marks around it, is flowing into the space and whether that concerns you or whether that's something for more sector specialists or sector investors that have experience should be wary of. I mean, all that stuff can smack of a short-term blow off top. And again, I think going back to the technical action in the futures that I mentioned earlier, that, that was one of those things that we saw happen that probably told me for the short, probably a multi-week period, we're going to take a breather in this move. But, while I'm seeing more interest in the space, while I'm seeing more, commentary about it, more coverage, obviously, we're covering it a little bit more actively at MoneyShow and MoneyShow virtual and live events just because people are asking about it. It doesn't have that sort of blow off type feeling. It doesn't have that, guy who's left, the shoe shine boy is talking about gold or gold stocks. It still doesn't have that feel to me. And I know that for a quantitatively sort of inclined person, talking about the feel of a market might kind of be, seem wishy-washy or whatever, but I don't think it is. I mean, you've been watching the markets for a long time. I've been in this business for more than a quarter century, and so I think the feel, the things that are sort of qualitative that you look for and that you see in blow-off moments, March 2000 and dot-coms, for example, or housing in 2005, I still don't get that sense for metals. So, it's not to say it couldn't change. It couldn't change quickly depending on, how the narrative goes, the price action, the money flows and so on. But I don't think we're there yet. I really don't.
So, in terms of money show conferences, you mentioned you're hearing some more people talk about the precious metals. Outside of those ones that always do talk about precious metals or resources in general, who are some of the new ones that are bringing this up that are paying attention?
Yeah, it's funny. I have friends that are in the business, in the financial industry, or that are, invest on their own, but don't follow things as closely as I do, given my role. And it's funny, especially with one group of friends that have always been more crypto inclined in the case of a few of them, and in the others, just kind of like used to joke, oh, your metals guy, ha, 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 who wants to buy shiny rocks? And it's funny. I used to get kind of mocked for that, but now after showing them the data, showing them the performance, now I'm starting to get those questions like, oh, tell me a little bit more. So that's sort of one of those funny anecdotes that I see in my own life in terms of my friends and colleagues and so on, if that's happening. But I, you see a little more coverage of it. You see some younger investors starting to ask about it and follow it. We work with Wolf Financial in that group, and there are a lot of younger investors and crypto-focused investors, but even they're starting to host some things focused on metals. So, those aren't your traditional metals investors historically, but they are looking to get involved. So that you're seeing more of that. But again, I feel like if I sort of had to categorize, I feel like it's more at the acceptance stage than the euphoria stage. You know what I mean?
Yeah, I totally do. We've seen more people show an interest in it, but you can tell these people are not diehards for the sector. It's still waiting for some of the younger audience to really take an interest, but they're still very much, I think, distracted by some other sectors. Let's just wrap it up with quick comments on the broad markets. Markets have been generally boring. The S&P still right around 6,000. Again, this whole Iran-Israel conflict put a little damper in the market, but didn't really do much. And we still have that whole taco trade. As you mentioned, it's a whole new buy the dip mentality. And we haven't heard much out of the White House to truly cause another dip like we saw a few months ago. And those dips have been shallower. We are recording this right before the Fed meeting and statement, but not a whole lot is expected out of that. So, what's your take on these markets?
Yeah, I mean, we're in that sort of betwixt and between period, but it's worth noting there are catalysts coming in the next couple of months. I mean, you mentioned the Fed, it's not cutting now, but come September, rate futures markets are starting to look for the first move or two in the back half of the year. If you look at in the trade and tariff front, obviously there's ostensibly the 90-day deadline that the administration set that can be pushed and changed for some countries and what have you, or for everybody for that matter. It's not something that is etched in stone, but that is coming up. So I think as we get closer to that, people are going to be paying more attention to what's happening in Washington and foreign capitals on the trade front. So you got that this summer. You've got sort of the economic news. I mean, if we don't start seeing more pass through from trade and tariffs in terms of inflation pressures, then that arguably is bullish because you can wait for something and say, oh, it's going to happen, but eventually you're waiting for Godot. So if we don't see that in the next month or two of data, then people are going to get more bullish that this is not hindering the economy greatly or not driving inflation through the roof. So a lot of these things in the next couple of months are going to turn from being, something that's over the horizon to being something that Wall Street has to confront and deal with. So, it may be a little quiet now, again, with the obvious caveat being geopolitics. But I think as you get towards further into the summer, that's when the rubber is going to meet the road. That's when markets are probably going to get exciting again. And, I think that's when we're really going to see another leg up if we can get, some trade deals, we can get some resolution on inflation, and we can get, a Fed that's starting to cut but not slashing rates because the economy is falling apart.
What have you thought of some of these recent so-called trade deals? The one with China, it's been dissected all over the place, and kind of what I've heard is that not a whole lot that's changed. If you go back before they got in that whole tariff war that said, I'm going to do this much, I'm going to do this much, I'm going to do 125%, we're kind of back to where we started, at least from what I've heard. Well, what's your takeaway from, again, a couple trade deals or so-called trade deals that have been done?
Yeah, I mean, you're absolutely right. When you look at the substance or you look behind the headlines, I mean, it does just kind of say, all right, we yelled at each other a lot, we did a bunch of threats, we caused all this volatility in the markets, all this short-term turmoil, but is it really changing the face of global trade? And is the huge multi-decade, multi-century pivot in U.S.-China relations or U.S. whoever relations? No. I mean, I think in the end, and I think that's sort of what Wall Street has come to grips with. It's that there is a lot more bark than bite here and a lot more talk than substance. And if that's the case, if that's truly the case, then the other stuff going on is going to take precedence. The cost of money, the underlying economic conditions, earnings growth, and we can get back to focusing on the stuff that Wall Street, historically does focus on when other distractions aren't out there floating around in the ether.
Yeah, it kind of reminds me of my little children, actually, how they can make a whole lot of noise, seem like they're doing a whole lot, and they walk out of the room and it's still a mess. So
Yeah, there's still
it
something to clean up, that's for sure.
oh man, it feels just like that. Hey, Mike, great chatting with you. Always interesting to hear what you're seeing in the markets and what you're hearing coming up at some of the money shows. So again, click that link in the show notes to find out where the next money show conference is. And I'll also touch base with Mike next month to see what other changes have happened in the market. So, Mike, thank you again for your time. Great chatting with you.
Great. Thanks for having me, Corey.